where you want to be. And of course, I'm excited that you're here because there's something that just happened in the US stock market that I wouldn't say guarantee, but it comes pretty close to guaranteeing that for the next 12 months, we will see an upward move in the US stock market. So if you've ever wanted to invest in the US stock market, now's a great time. I'm going to show you why. A couple of years ago, I guess it's actually been almost 3 years ago, this January, Paul had me introduced to the Actions to Wealth community through a class called Banking on Randomness. It was part of the mentorship series, and since then I've taught classes around supercharging your trading results a couple of times, and in each case I have shared research that was published first in the book that I co-authored with Tony Turner called Invest to Win. But this was more updated and extended research. That book was published in 2013, but I took data all the way up to 2019 and showed this particular finding, and that is that if the S&P 500 rapidly moves up over the course of 20 trading days, 1 month, one calendar month, basically, to a certain extent, there's a threshold at which that becomes meaningful. But the higher and higher it goes, the more and more meaningful it becomes. Now, what I shared, I'm going to try and share my screen here so you can see this graphic from that class. Let's see, there's the zoom, but I'm not seeing oh, I see why. Okay, there it is. I'm going to share screen and coming over here, and here we go. This slide shows data from the S&P 500 ETF, SPY, from 1993 all the way up to 2019. So you're talking about 26 years worth of data. And what happens is that if you get some price point, the close of any given day, and from that day forward 20 days, right? If it goes up just 1%, or if it goes down, or if it goes sideways, that doesn't seem to predict what's going to happen with the S&P for the subsequent 252 days. But if all of a sudden you start going up more and more and more, then it begins to be predictive. If you go up more than 5%, then it says that you're likely to go up more than average. Now, the thing about the S&P 500 is that over the past almost 100 years, the index data is trackable, it goes up on average. And in this slide, I show you this brown line right here, which is kind of the average of all the past 26 years in this study, right? Notice that if it goes up less than, if it goes down more than 7%, the gray line, then it doesn't meet the average. So I misspoke. I said it wasn't predictive. It wasn't predictive of a bullish market. It was predictive of poor performance market, right? So on average, it goes up from 0 to about 1%. Is that right? No, sorry, 10%. Yeah, this is including dividends, right? So about 11% a year on average, if you include the dividends that the S&P 500 pays out for that 26-year period. Okay, and that's a pretty good year, right? Well, if it goes up more than, if it goes down, then it does less than that. On average, it's 5%. Well, I mean, we've seen what the S&P 500 can do. It can go down a lot more than just go up 5%. It could go minus 20%, like it did in 2022, just last year, right? But if in fact you have a 1 month period where it goes up more than 5%, then all of a sudden you start to anticipate that you're going to get above average performance. If you go up more than 7%, then you get much more than above average performance, at least, for the first uh, several months. This is the number of weeks, right? And you can see that for about 42 weeks, you get a really strong upward trend after a 7% run. So, a lot of people look at that and like, well, the market's up 7%. It's clearly gone up too much. It's going to revert back to the mean. Well, if you're a currency trader, you're really used to reversion to the mean behavior. But the US stock market is not that way. If in fact you get a strong move in one direction, the tendency is for that strong move to continue for several months thereafter. And that's what the data shows. Now, I don't have a line here for an even more predictive, more highly, high performance. And if I had another line here, it would come way up here to 10% at about the 40-week line, right? It would be a line that shows the performance during years following a month where the S&P rises 10%. In fact, 10% in my own study, that threshold was the most predictive of a bullish market thereafter, and not only a bullish market, but a strong bullish move, at least for about 40 weeks. 40 weeks, that's going to be about 7 months or so. Let me show you then. Chart. There it is. What just happened from October 30th to November 30th? We had an 11% increase. Huge. And this, I've heard this described as one of the most vicious V bottoms in market history, right? Well, I remember in November back in 2001 where something similar occurred after the 9/11 towers getting blown down or collapsing in New York City, and sending markets into a panic for about 6 weeks. Then the month of November just roared higher, at least on the NASDAQ. On the S&P, it went higher, but not quite as much. It looked a lot like this. You're coming down, all of a sudden, so up it goes. And this did not predict, because the S&P 500 didn't go up as much like this. It did not predict a bullish market the year after. In fact, what came over the next year was a big bear market, 2002. But for the next month or two, it did go up. It kept going up until, about January. And then somewhere late January, February, it started going down. And 2002 turned out to be a terrible year, right? Could this year be the same kind of thing? Could we see a terrible year in 2024? We could, but I do not expect that we will. I mean, there's lots of reasons why it could be bad, right? All sorts of geopolitical tension, all sorts of financial potential crisis that could happen. Interest rates are high. Inflation is still being combated in the U.S. markets. Outside the U.S., you've got a variety of other things that I could opine about. But the problem is, I should say, there's no shortage of bad news headlines out there. Okay, no shortage of that. So yeah, we could have a bad year in 2024. But generally speaking, the market has not crumbled under higher interest rates or higher inflation or the geopolitical tensions or the U.S. presidential race scheduled for next year. The market hasn't shied away from any of that. It went up 10%, 11% during the month of November, just this past November. So, what's going on? Well, the answer is because inflation and rates are high, savers and investors know they have to be able to outpace, they have to outrun inflation. They can't just sit back and put their money in the bank. They're going to fall behind. Now, they could take their money and put it into CDs or um, bonds and get 5% back, 5% return. And that's pretty good return these days compared to where we've been the past couple of decades. But it's not going to put them very far ahead of inflation if inflation is going to run at 3.5 or 4%. It's going to just be, in real terms, they're only going to increase by about 1%. Where are they going to find returns that are going to keep them ahead of inflation, 5, 10, 15, 20 years ahead? And the answer is more likely to be the stock market. You have a lot of kids. This is a really interesting thing. If you don't know this, in America right now, the age group, or the highest population, I should say this way, the highest chunk of the population is the group between about 25 and 35. There are more people in that age group right now than there are, the 5 to 15s, the 15 to 25s, um, the 35 to 45s, 45 to 55, 55 to 65, and so forth. Now, I happen to have 5 children, and 4 of them fall inside that window, that the age group of 25 to 35. And they are all of them at the sort of age where they are forming a family and considering buying a house, maybe something like that. They're kind of at that age. Now, not all of them are doing the same thing at the same time, but what they are doing is the ones that have a good job, right? I went to school, or um, my kids got good jobs even before they finished school. I've been very blessed that way. They have my children have all been financially successful, and um, what I have noticed about them is that those who are not still full time in school, they have the ability to save and the desire to save. And they like to save through retirement savings vehicles like 401k or IRA or whatever. But it's basically the idea you put money away and the government won't tax that money until you get to retirement, right? And so every 2 weeks that they get a paycheck, a certain chunk of it goes right into that particular kind of savings account. It's not a bank savings account, it's an investment account. And where do the investments go? Most of it for young kids goes to the stock market. See, people like me who are, you know, more in the upper age ranges, right? They they don't necessarily want the risk of up and down stock markets. They're much more likely to be buying bonds or holding on to CDs or something. Now, me, I'm a little bit of an outlier. I just love trading in the market, so I'm all in. Right, I'm in the stock market. My money is in the stock market. But my kids, if you ask them, do you invest in stocks? They're like, oh, no, I don't. Don't tell them. They do, right? They do because they use these 401ks and then they put their money in the growth fund or whatever. And if they ask me, yeah, I give them my advice. But they do what they want to do, right? Well, most kids their age do put their money in some growth fund. And what does a growth fund do? It puts money right there in the S&P 500. The S&P 500 or something like it, NASDAQ 100 or other index, is the largest U.S. companies, and stocks or money just goes right to those stocks, right from people's paychecks, right into those stocks every couple of weeks. Now, it doesn't all go at the same time. Otherwise, you'd see this nice 2 week, every 2 week step, right? It's everybody's staggered and they're putting this money in. It's like, where's the money coming from if everybody's doing so economically poorly? Well, number one, they're not doing poorly. Number two, it's coming from their paychecks, going into their retirement savings, going into the investing accounts available to them. Now, they don't have investing accounts that have a wide array of sophisticated choices. They can't invest in commercial real estate unless they buy a stock that, ETF that invests in, or a REIT or something. But most kids, most investors in the U.S., they're not sophisticated enough to know how to go to their custodian, the people that are managing the money, and say, hey, can you take it out of all those growth fund stuff? I just want to pick stocks. They can do it, but most don't, and they don't bother. They don't take the trouble. Most just put their money into one of the funds available to them. And these funds are usually mutual funds that are tied to some kind of an index. And the index is usually either growth, which means stocks, various kinds of stocks, or income, which means various kinds of bonds. So, and then they have stuff called blended, right? And that's a mix of the two of them. They also have things called target funds, which are really popular, especially among the younger group. A target fund says, I want to retire at some year in the future, 2050 or whatever. So invest my funds with the idea that I'm going to retire there. Well, if I'm 30 years away from that, that means it's all in stocks. And then as I get closer and closer, it shifts from stocks, 100% stocks, to 80-20 stocks and bonds, 60-40 stocks and bonds. It gets more and more bonds as they get closer and closer to retirement. That's what those target funds do. So for young kids, they're all in, baby. Push the chips on the table. I'm in the stocks. That's what they're doing, whether they know it or not. So that's where the money is coming from. People who are working and earning, and they're just naturally saving, and they're putting money in. Now, the money managers, where that money comes to them, they like, well, okay, let's not put it in just yet because the market's going poorly. That's what it looks like when you have this downward market. But once they decide the down market is done, they're like, okay, quick, just start activating, and then you get this huge, these big run-ups like this, right? And there's other things too. But generally speaking, it's like, why is it going to go up? And why, Gordon, would you expect it to keep going up? Well, the answer is the money managers and the U.S. investors that did this, that put all that money in, they don't want to see that investment. They're not traders, they're investors. They like to leave stuff in for at least a year. And so for the next 6 or 7 months, there's a good likelihood that none of these people are going to, put their foot on the brake and pull out of the markets. They're going to say, yep, let it ride, keep it going. Let's see what happens. And so because it's high, other people look and say, wow, hey, market's gone up. I'm going to put my money in there too. And that's the sort of positive cycle, virtuous cycle, they call it, that just creates the reinforcement for the market drifting higher. That's the momentum, or I should say momentum investors say basically a high price means, predicts higher prices. That's the core of momentum. Well, we just got this huge signal. And what I'm saying is that every time I've gone back, when I go back to the data, every time I see this signal, 9 out of 10 times, it is a positive market. More than 9 out of 10 times, but 9 out of 10 times, you will, and when I say more, I mean like, 95 out of 100, but there haven't been 100 occasions of it in the past 30 years. Um, so better than 90% of the time, you do get a bullish market, and not just a bullish market, but a strong bullish market. On average, the 10% threshold or above is the strongest indicator that over the next year you're going to have positive earnings, and that the biggest, fastest growth of those earnings are going to come within the 6 months that follows this particular signal. So how then, if you decided, okay, well, maybe Gordon's right, what should I do? Which stock should I buy? Here's a colorful chart that might not mean a lot to you unless you know what it's trying to show you. I took a list of the 20 most liquid option stocks out there, and I threw them all on this chart all at the same time. That's all the different colored lines, to see who over the past 3 months, so we're just at the start of December, start of November, October, September. I'm going to put that right there. Okay, I want to know which stocks have performed relatively the best over the past 3 months. So this is going to include that period that kind of comes down, bounces off the bottom, and starts running up, right? If in fact you find what has relative strength, okay, that's what means this, comparatively better movement. If a stock has relative strength over the past 3 months and the markets move bullishly, that stock is more likely to be among, not the only, but among the leaders going forward in a bullish market. So I just want to know, out of my 20 big large cap stocks that have the most liquid options, because if I like to trade options, I like to trade these stocks, right? Then which ones are doing the best? See that golden line right there? I want to know what stock that is. Now, I got to tell you, out of this list of 20 stocks like Apple, Microsoft, Amazon, Google, Facebook or Meta, Netflix, Nvidia, Verizon, stuff like that, right? They're all household names. What stock do you think did the best in the last 3 months? Okay, it was shocking to me to know the answer was Intel. Yeah, the computer chip maker, Intel. I mean, chips, okay, I get semiconductors, that's big, but Intel, they have been a horrible stock for years. And now all of a sudden, they're leading. They're leading the likes of Nvidia and Micron and Microsoft. Intel has done the best over the past 3 months. So going forward to the next 6 months, what stock would be most interesting? Well, this is just educational only. I'm not recommending that you put your money in there or soliciting a buy. I'm just saying, in the past, stuff that looks like this tends to do well. And I would not have guessed that right now was a great time to be buying Intel. But this chart seems to indicate that, yes, it is. How about the other ones? Let's look at the first top 2 or 3 here. That one is Microsoft. And then this one right here, this little purple line that's shooting up like that, that turns out to be Citi Group. That's a bank, Citicorp Bank. And so Microsoft, Citigroup, and Intel, those are the top 3. And if you like doing options on stocks, you should consider option plays on one of those 3 stocks if figure out which one's the best. I'm not saying run out and trade it right now. Just buy call options. Go, baby, buy with both hands. No, of course, you do something like that, you lose money. You got to get strategic. You got to sort of figure it out. If you don't know the options game, now would be a great time to start trying to listen to people who can teach it to you and learn something about it. If not, but if you do know options, well, now's a great time to be hustling around figuring out what option plays you can make. If you're looking for my suggestion, I'd say start by considering one of those three stocks. Generally speaking, though, the U.S. market is likely to be strong and remain strong for the next 6 months to a year. And what does that mean for currencies? Well, I'll just, by comparison, show you this. This is the US dollar. And look at how during this same period of time, the US dollar has topped out and started coming down, right? Stocks went up strongly, US dollar coming down. Why is the US dollar coming down? Well, probably because the Fed has sort of kind of let people know we're not likely to raise rates. We're going to either hold them here or maybe cut. We're not sure. And I think the markets are betting that they're going to actually start cutting rates at least a little coming into 2024, and that is being reflected in the US dollar falling down. That's a huge opportunity for currency investors because anything that has a dollar denominated pair, euro dollar, Aussie dollar, British pound, US dollar, right, is likely to have a little bit of lift added to it. So it could be very much the case that for the next 6 months, you could by default be bullish on euro trade. See, there's the corresponding move. See how it follows right along with the stock market, right? And then, of course, if you've ever heard me before, then talk about currencies before, that I have advocated watching the Aussie yen as a pair that corresponds to the U.S. stock market. And it used to be 2 or 3 years ago that was the most predictive pair, at least in terms of correlating with the U.S. stock market. But nowadays, because the U.S. dollar, because U.S. Interest rates are so much higher, people can get more money on what's called the carry trade using USD JPY. So this is going to have but you got to do it with the dollar on. USD JPY. That's dollar yen, right? That's the carry trade. But in order for it to be sort of going along with, predictive of, or following along with the U.S. markets, you have to switch that. So what you get is JPY USD, right? And this chart, you might not trade it this way. You might trade dollar yen, and you would sell it. You'd short dollar, long yen, and then this is what you get. And you see how this is moving up right now, right? That's so if in the currency world, all of the dynamics I just talked about, they're going to roll over and play into. You're going to see dollar yen tend to have a little pressure on it, or yen dollar going up, and you're going to see euro and Aussie dollar also likely to USD trend higher. See, Australian dollar versus the US dollar. So hopefully that gives you an idea based on the market conditions. Any questions here before I take off? Let me get to the. There it is. Okay, great. Well, I hope that this information has been useful to you. And just to let you know, this signal is very strong. And to recap, it's indicative of a bullish year for 2024 in the U.S. stock market. And of course, that carries over to the other things. That's the synopsis. And I hope that information helps you in your future trading and investing decisions. Till next time, take care and trade well.